Corporate finance presentation, exchanges. Get ready, it's time to take your chance with corporate finance. Exchanges are a primary tool corporations use in order to help generate capital. The exchanges basically being a link between the companies, the people that need capital, need money for investment, and the people that have the money and would like to invest it in order to generate a return. Most of us in the US, when we think about exchanges, we usually think about the New York Stock Exchange. Here's an older picture and a newer picture where we have the actual floor, and we can imagine that being the hub of when the transactions are going to be taking place. Obviously, as technology is changing over time, that's going to change our thought process and some of the systems with regards to the exchanges as well. Large exchanges include the New York Stock Exchange and the NASDAQ. These are the two that we'll basically be comparing in this presentation. Companies must meet listing requirements and be approved by the exchange's board of governors. Now, obviously, to be able to be listed on an exchange can give a lot more access to potential capital because there's more people that can basically get access to the capital through the exchanges. To get on the exchange, however, there's got to be some kind of regulatory process because the more trust there is in the process to be on the exchange, then the more likely people are to invest money. So part of the process with the exchange is that we are now giving access to the public to be putting money into the companies, and there has to be some hurdles that needs to be cleared in order to give access to the public. And you can see this in the history of the exchanges in terms of trading stocks, where there's been certain areas that there's been scams and frauds that have taken place. Those things, of course, will lower the confidence of people to invest, and that lowering of confidence will result in less capital flowing into the markets as people are skeptical. So notice that some of these regulations that might be, one, self-imposed by the exchanges themselves, and two, imposed outside by organizations such as the SEC, Securities and Exchange Commissions, things like requiring audits and financial statements and to be able to show that the financial statements have been constructed in conformity with some general standards such as generally accepted accounting principles or some other basic general standard will increase the level of trust, and that will also increase the level of capital, hopefully, that will flow into the exchanges. So electronic communication networks, the ECNs, electronic trading systems that will automatically buy and sell orders at prices that are specified. Now, this, you can imagine, of course, has changed a lot, the process of the trading process, because you no longer are thinking that you have to physically take the trade happening on a central location, such as the floor of the New York Stock Exchange, if you can basically make a more electronic type of transactions, and the electronic communication networks, the ECNs, are helpful in doing that. Can call alternative trading systems. You may also call them electronic communication system, ECNs, or the alternative trading system, the ATSs. May choose to act as a broker-dealer or an exchange. So you can see how this could work then, these systems, the electronic communication systems, as basically a broker-dealer to make that a more automated process. And as you make it a more automated process, it lowers, you would think, the cost due to the less human hours, man hours, woman hours that would be necessary for the process. Or you can think of it as basically the exchange itself, as basically making these transactions in terms of an exchange. We will not have exchange floor or physical trading posts. So if you're using the electronic communication network, then you may not need then that physical location, which was so central before that time, because obviously before that time we needed everything needed to be centralized so that you could basically have all the transactions going through that central location. As things are going through a network now, it may be possible then to make the transactions and whatnot without necessarily needing a post on the floor or some centralized area, which again can make you think a lot differently or change the way things work possibly. So the trading costs are lower too, which again, you can imagine that to be the case because now the trades should be able to be done a lot more easily if you can basically automate the process for the trade. So the New York Stock Exchange, this is probably, again, the exchange in the U.S. that you imagine most, And you can imagine basically historically going back and up to today and looking at the trading floor and seeing all the activity that is happening there. So the New York Stock Exchange became a public company in 2006. There are thousands of large companies with shares listed on the New York Stock Exchange. The New York Stock Exchange was acquired by the Intercontinental Exchange in 2012. Then we have the NASDAQ, which is our kind of comparing and contrasting here. The NASDAQ is recognized as a national securities exchange by the SEC, the Securities and Exchange Commission. All the trades are electronic. So this one, the NASDAQ, you can kind of think of as like, the more modern trading system where things are, almost you can think about it basically like in the cloud, more dispersed, less centralized into a location. There's no trading floor, no specialists. So we're not thinking about the NASDAQ. You're not thinking about people on the floor making the trades on the floor. So it is the largest exchange in the U.S. measured by dollar trading volume. Created Super Montage electronic trading system that integrates trading process with limit orders, timestamps for receipt of orders, and so on. So you can imagine, again, it basically being as electronic kind of system. To do that, we have the Electronic Communication Network, the ECN. So that ECM now working as the NASDAQ. That's called the INET, or sometimes it's called BRUT, B-R-U-T. Then we also have foreign exchanges. So many U.S. international companies trade on the foreign stock exchanges. So you might see then, notice if you're on more exchanges, then that should give you, you would think, access to more capital. You have more people able to give money into the business. Now, as we're on more exchanges, however, note that every exchange needs to they're trying to all provide that level of confidence. That's part of the process to be on an exchange. And part of the process of having a level of confidence is to have things like an audit, have things like regulations. You're required to put your financial statements in a set format. You're required to do things on the accounting side so that you can't intentionally deceive people by having a different type of accounting format, right? They're trying to standardize the accounting formats. This is something that's a little bit more difficult over different countries because, of course, there's arguments about whose rules should you be taking place in. Which accounting standards are the ones that you have to comply with? Because if you have different accounting standards, that's going to lower the level of confidence given the fact it's more difficult to compare companies that have different accounting standards that are being used on their books. So those things are complicating things, and there's obviously work to try to come to some kind of understanding. But again, you can understand how each company or each country and each exchange is skeptical about, conforming to each other's rules and whatnot. But there's more international, so many foreign companies trade on the New York Stock Exchange. So the fact that we have, companies that are U.S. companies trading here and possibly on other exchanges, and foreign companies exchanging on their exchange plus on the New York Stock Exchange is kind of a good sign that the international capital markets are becoming more important. Note that a lot of times that could be difficult to do, too. They might be jumping through more hurdles to do that because, again, that might mean that they have to actually do their entire books on different accounting standards. That might be that they're subject to different auditing requirements for the different kind of exchanges and whatnot. And so the fact that they're willing to go through the added hoops that they might be going through to clear the regulations on different countries and different exchanges shows that the companies think it's worthwhile to do so, and that could be a good thing. And of course, again, if there could be some standardization on these types of exchanges so that you have more people available in more capital, that's always something that they are working towards. We also have the futures exchanges, which can be used to hedge interest rates on commodity prices and commodity prices. The GME Group is one of the largest future exchanges.